What's up, everybody? Welcome to this weekend's episode of the Weekly Wrap. This is episode 4, and wow, what a week we had this week. We saw a lot of big tech earnings this week. We saw some mixed results, some mixed reactions. We saw Intel get crushed. We saw Roku get crushed. We saw Apple and Amazon have optimistic reactions. So there was a lot going on this week. We had the White House redefining the definition of a recession. So I kind of just want to start there, actually, before we get into this first piece about retail investors. So I saw a video this week, and a White House reporter asked the spokesperson, I'm forgetting her name, so I apologize, but basically just the spokesperson for the White House, and they said, why have you been trying to redefine the definition of a recession? The definition of a recession is 2 consecutive declines in real gross domestic product. And she said that's not the definition. And she kept reiterating that this was not the definition of a recession. I think there's 2 things going on here. I think, one, obviously the White House knows that that's the definition of recession. So first of all, you got to be careful because you can't always look to the news. I know that's kind of what we do here a little bit, but I kind of like to just give my take on what's being put out there, not really just copying and pasting the news and saying, oh, this is what the news is saying, so this is law. Like, I just like to give my thoughts on it, whether I think it's right or not. So, you got to be careful because you can't let government propaganda sway you one way or another. You have to be completely emotionless. I don't care if you're a Democrat, conservative, or if you don't care, you can't let the propaganda sway you. So that's first of all. The definition of a recession is that we have 2 consecutive quarters of a decline in gross domestic product, and guess what? We have. So we're in a recession right now. We are in a recession. I don't care what the White House says. We are in a recession. We're even starting to see jobless numbers start to tick up. And if the Fed keeps raising interest rates, which it looks like they're going to, it's going to get worse. So we're in a recession. Be careful. That's just what I want to say. Be careful. The second thing is the White House knows that they don't have any power over the Fed, but they got to kind of work together with the Fed if they want to get out of this economic environment we're in. So if they know that the Fed needs to continue to raise rates, they need to spew out as much as they can that we are not in a recession so that the Fed can still raise rates without just the economy spiraling out of control. So, it's tough. It's tough. It's a little bit scary when you see government changing basic definitions of economic environments. Like, I was kind of shocked when I saw that, honestly, that they just wanted to change the definition, and then you saw on Wikipedia the definition changed from what it was before of a recession. So it's just a little bit scary when you start to see censoring and propaganda like that, but that's just the world we live in, and it's better to just be informed than to listen to what the news or the White House or the government tells you. So you just really got to be emotionless and be analytical about it and stick to your plan and not let even the White House sway you in what you should do. So I want to start here with kind of like retail sentiment because that's important to the markets, obviously, and individual investors ramp up bet on tech stocks. So shares of Amazon, Alphabet, Meta have suffered double-digit declines, but believers say they expect a rebound. And that's true, there will be a rebound at some point, but is this the rebound? Have we hit the bottom, or is this another bear market rally? And, I think it's tough to tell. So the bad thing is that if Wall Street decides that they haven't seen the capitulation they want, and usually the way it works is the pendulum of the market kind of sways too much in one direction. So when we're in a bull market, it sways way too optimistic and prices get too high, which is kind of what happened in 2020 and 2021. And then in a bear market, the pendulum swings the other way and prices go too low and there's too much pessimism in the market. And I don't think we've seen that yet. I don't think we've seen extreme pessimism and despair yet. which is why I'm not necessarily convinced that we've seen the bottom. And especially because of things like this. So even though that tech is down a lot, just seeing the optimism in retail investors and seeing how much money they're pouring in is not a good sign, because Warren Buffett, he has a famous quote that says the market can remain irrational longer than you can remain solvent. Basically saying the market is always going to suck the most money it can out of retail investors. This is the way it works. That's how the rich keep getting richer. That's how Wall Street makes their money, is sucking our money right out of our brokerages and our bank accounts. So I don't think we've seen extreme despair and capitulation yet, and especially if we're seeing the Fed put more and more pressure on the economy, and we see more foreclosures start to rise, and we see more jobless numbers come in. I mean, I'm not convinced we've seen the bottom of the stock market yet. I don't think we've seen that capitulation to the downside, and I think that usually that happens before you go from a bear market to another bull market, and we've been in a huge bull market since 2009 basically. I'm just not convinced that we've seen that yet. So the tech stocks were up a lot this week after their earnings, and it's been a fruitful bet for a lot of people. We see this 27-year-old investor who used to work for Alphabet said that he's extremely optimistic because of his experience working in the firm. And you know what? That's probably true. I bet tech in the long term is going to go up a lot. So the best strategy is to buy and hold, especially because this man's 27 years old. I'm also pretty young, so I'm just buying and holding, dollar cost averaging no matter what. But in the short term, I think going all in and thinking that the bottom already came in is a little bit irrational to say. So maybe it has. The NASDAQ and tech stocks typically do bottom before the rest of the market, but I'm not convinced that we've seen that just yet. So I say that to say just don't put all your eggs in one basket. You have to invest smartly and stick to your long-term plan. I thought this was interesting. That same investor said he also holds a small position in Cathie Wood's ARK Innovation Fund. And that's kind of just a basket of really early stage growth innovation stocks that have just gotten absolutely hammered, mostly because most of them aren't profitable. So a lot of the prices were just out of control, speculation, and when the economic environment changed, a lot of that speculation was just crushed. So her fund is just really, really cheap right now, and he said he's not selling. So I thought that was interesting. But I brought this up to kind of lead us into this story, which is a new bull market can't start until investors give up. And usually I don't agree with the news all the time, especially with headlines, because they're kind of used by the bigger institutions to sway our opinions. But I agree. I don't think a new bull market can start until investors give up, and investors have not given up. The first line of this article is, in order for the stock market to live, Cathie Wood has to die. And that's really extreme. It's really extreme. I think that hedge funds and institutional investors hate Cathie Wood because for a long time she was crushing them, and she was doing it while posting her moves every single day. So she was letting everyone know what she was doing, and she was still beating them. So I think that really rubbed a lot of hedge fund managers and a lot of institutional investors the wrong way. And in a lot of ways, her fund was extremely overpriced. Like, a lot of her companies are not profitable right now. And the fact that it was up 450% in like 2 years is kind of ridiculous, but the underlying stocks in there I don't think have to die. I think that the speculation has to die, which you could argue has already happened in her fund, as it's trading at COVID crash levels when the market crashed in 2020, so it's below its 2019 prices. So I would say the fund has died from where it was at. I think if you go into any sort of news channel or even stock twits, if you know where that is, I kind of use stock twits to gauge retail sentiment. And honestly, it's usually a good thing to do the opposite of what stock twits sentiment is, because usually when everyone is bullish, that's when it goes bearish, and when everyone is bearish, that's when it goes bullish. But Cathie Wood's fund has been getting increasingly bearish sentiment, and just absolutely talked down on by everyone. So I would argue that her fund has died, and that they need that kind of sentiment to spread to the overall market before it can go up. I don't think it needs to get that bad, but it needs to. The sentiment needs to get worse if they want to switch to a bull market. And I think it's important for that to happen, but like also I think if the sentiment got that bad in the broader market and we saw capitulation, but the Fed was still raising rates, that I still wouldn't be convinced that we had hit the bottom, because the economic indicator that almost follows the market in lockstep is just QE and QT. So right now we're in QT, which is basically just it's reinforcing my opinion, basically. Until the Fed pivots, I won't change my mind. If the Fed pivots and we haven't seen that capitulation, I would still change my mind to being bullish, because that's really the only indicator you need to look at, and all the rest of this is kind of just little intricacies. So this chart shows equity mutual fund inflows, which basically just goes to show like the sentiment in the market. If the equity mutual fund inflows are higher, that means people are bullish. If the equity mutual fund inflows are lower, that means that retail investors are bearish. And you see we're starting to go bearish for the first time since the global financial crisis. So that is interesting. Actually, no, this chart is out of date. This is only from 2009. What? That's really interesting. So this is from the global financial crisis, and you can see that it was mostly bearish. And if we come to this chart, which is the Goldman Sachs non-profitable technology index, so basically this is just an index that Goldman Sachs uses to track sentiment around speculation, because if a company is non-profitable but the price is going up, basically you're speculating on what the future cash flows could be in the future. And when it drops to levels like before this huge QE push, so like you see this was when the Fed pivoted, March 2020. This is when the Fed pivoted to a huge QE. And the index was about 84. So it rose from 84 to 427, and that's all speculation. And now since the Fed has pivoted again to QT environment, it's fallen from 424 to 128. So before the crash in 2020, it was at 131. So it's about at the same level as it was before then. So all that speculation that came into the market during COVID has pretty much been wiped out. And that's why I am thinking that Cathie's fund is already dead, because I was basically, if you look at her fund, it basically just looks like this, because it's a lot of the money that was going in was based on speculation. I wouldn't say that Cathie Wood's investments are speculation. I would say that the investments in her fund were speculation, and in those companies from retail investors were speculation. But she posts her own research and her own time horizons that back up that she's not speculating. So yeah, that's all I'll say about that. So this article just goes on to say, at the end of it, kind of they went back and kind of scanned news headlines when the market was actually capitulating and bottoming, and there were a lot more negative sentiment around the market than now. Like, there's still too much optimism is basically what they're saying in the news. So that's something to think about too. I want to talk about the tech earnings though. So a lot of people were confused why companies like Amazon could report a second straight quarter of losses and still gain so much. And in my opinion, there's two things that can kind of affect that. One is that by some metrics, Amazon missed by less than what people were expecting. So it wasn't as bad as people were really expecting. So they bought up, which isn't always a great strategy, but that's just my rationale behind what happened. And the second is that some of Amazon's businesses, like AWS, are not going to really be affected by what's happening in the market. Like, that's a business that's going to keep growing regardless, and I think people recognize that, and they understand the power that Amazon really has. So yeah, I think we live in a really interesting time where companies like Alphabet and Amazon and Apple and even Microsoft just have like this power over us that no company or corporation has ever had. And I think people are like kind of starting to recognize that. And yeah, that's kind of my rationale behind why that happened. Apple beat on their EPS and on their iPhone sales, and that's why they went up. And they brought in record revenues for the quarter, so they weren't showing any signs of slowing down. And I think people were thinking that if they can do that now, then what's to stop them in the future? Because if this is a really bad economic environment, Apple's still double beating on expectations, then what can slow them down? And you know what can slow Apple down? I don't know. I think it would take a lot, and it would take something that I can't even think in my mind. So that's how big their moat is. So lower prices just mean more opportunity, but yeah. So it wasn't true for all companies. Intel suffered, but they're not really on the same playing field as these companies. There's just, I'm not even going to go into the rest of this article because I want to talk about the difference between those types of companies and the rest of even the NASDAQ and tech companies. Is it's tough to bet against companies that can go into any market and put anybody out of business. Like, for instance, when Peloton was growing and growing and the stock was skyrocketing, and I had some friends ask me, what do you think about Peloton stock? I'm investing in Peloton stock. And I just didn't buy into it, because a company like Apple could come in and say, hey, we're making our own gym equipment integrated with Apple technology, and you can hook up your iPhone and your Apple Watch to it, and bang, Peloton's dead. Just like that, overnight, they're dead. Amazon, they can go into the healthcare industry and put a lot of people out of business. They can go into food delivery. They bought a stake in Grubhub, or the cloud service, or these companies can put anybody out of business. And that's the difference between them and like an Intel or Roku that fell this week, even though it was a tech stock, or I'm trying to think of another one, Snapchat or Twitter. Like, these companies can't go to other places in the market and just start putting people out of business. But it's companies like Apple and Amazon and Alphabet that can. They have more resources than any group of people ever to live. So it's just different. And for me, I have a hard time investing in companies that could be put out of business by one of these companies. And frankly, I don't invest in companies that could be put out of business by these, because why do that when you can just invest in the company that could do it better, make more money, be more profitable, and put everybody else out of business and increase their market share? So yeah, it's not looking great in the economic environment for short-term stock prices, but like, if you're investing for the long term and you're just dollar cost averaging, don't go reaching for bad companies or companies that can be put out of business by the big guys. Typically, I see some people saying they won't invest in Apple or Amazon or Alphabet because they think they missed out on the gains, or they think they're too big. And the truth is that these companies have had enormous gains from entering different markets. For instance, Amazon, AWS, is one of the most profitable parts of their business right now. that was not even part of their business when they first started selling things online, when they first really start to become well known in the markets and have most of their gains. Like, that wasn't even a thing. In the future, these companies are preparing to enter markets that equally can, or similarly can, exponentially expand their profits and their valuations, and they haven't even started dabbling in those markets yet. So that's why I think it's definitely not too late to invest in these companies. I think it's kind of silly to not invest in these companies just because of market cap. And also, these companies are basically ETFs. If you break down Apple and Alphabet and Amazon and Microsoft into the different segments of their business and the different companies basically within them, I mean, there's 7 to 12 companies within each of these conglomerates. So you're basically buying into a fund of companies by buying them anyways. For instance, Google has their search engine, they have a cloud service, they have YouTube TV, they have autonomous driving technology that they're building. Apple has the iPhone, the Mac, the iPad, their wearables, their fitness platform. They're entering the car space. Obviously, they have their iCloud. Amazon has AWS, Amazon.com, where you go shop for things. They've entered the healthcare field. They bought Whole Foods. I just don't think people understand, and that's going to continue to happen until the only thing that would stop that is the government breaking them up. And frankly, I don't think the government is competent enough or knows enough about the businesses to break them up. Like, we're just living in a different time now. So I think that, yeah, you can be bearish on the overall market, but to be long-term bearish on those companies is just silly, frankly. So that's just what I wanted to say about those. I have strong opinions on that. I think it's really dangerous to bet against these firms that have a lot of power. So with that said, I want to get into kind of the broader market valuations, and I want to start with the historical S&P P/E ratio. So all this is the S&P's price over the S&P's earnings since, I believe this is a little bit before 1950, all the way to now. It's January 2022 it goes to, so, or this year, so. Typically, the average is somewhere around 15, in between 10 to 20, until it was hovering from 10 to 20, with it going lower during recessions, until it cracked above in the early 90s, but then really the dot-com bubble is when it went above 20 consistently, and then it came back down and went into the 15 range in 2011, and then it rose until now. Now it's coming back down. So if you truly want to see like a long-term return to the average of S&P 500 valuations based on the P/E, we still have a little bit ways to drop. The only differences is like the companies that make up the most weight in the S&P 500 now have historically traded at higher P/E ratios than 15. So I'm talking about the companies we just talked about, Apple, Amazon, Alphabet, Microsoft. They trade at higher price to earnings because they know that their growth is typically faster than the rest of the market. So that's why that they trade at kind of like that premium. So if you want to see that capitulation, yeah, this could go lower, but you can't like look at the average now and say that it's going to be the average from back then. But I could be wrong there. I'm not afraid to say that I could be wrong. In the short term, yeah, we could definitely see this ratio fall. But I just want to bring it up for you to draw your own conclusions. If you want to take it, this is my preferred way to value stocks, and it's the Shiller Pe ratio. So basically, that's the price of the stock market over the average of the last 10 year of earnings adjusted for inflation. So it's a little bit accurate at kind of capturing the real valuations of the stock market. So typically the worst crashes in the stock market, the first one happened at a Shiller Pe ratio of 30. The second one happened at, ironically, not even that high. It was at 17. This one actually back here was in the mid-20s. But the dot-com bubble reached almost 45, and we were hovering around 37. And right now we're at about 30. The average for this is also between 15 and 20. Probably closer to 20 if you take into account some of the more recent bull runs, but we're still really, really high. We're basically like a third over the average. So there's definitely room for the breadth of the market to fall. Of course, like if you want to take into account this ratio that values the whole market. So, yeah, I think it's smart to keep dollar cost averaging. Obviously, the valuations have fallen a lot, but there's still room to go if you want to go to like a mean reversion. So, yeah, this is just something to keep in mind, and I haven't really brought anything up on the weekly wrap episodes yet similar to this, so I just wanted to bear that in mind. So you see the average is actually 16, so we're at 30, so we're really almost 50% over. So yeah, you could see the markets fall. I hate saying this because I don't like to scare people, but from the top that we were at, you could see the market down 50%, which would mean we're not even close to the bottom. Would the Fed pivot before we hit that point? Maybe. Would that change the trend of stocks? Yeah, definitely would. That's what happened during the COVID crash. That's what the Fed's basically been doing since the global financial crisis, is pivoting to not let that happen. But I think it would be healthiest for the market to really capitulate down like that. I think fair valuations are better. That's really what a free market is, but it would cause a lot of pain and a lot of panic for a lot of investors, and I think that's why the Fed doesn't let that happen. So will we ever see that type of valuation again? Maybe not, especially with the way we've seen it in the past. I don't know, but I think with inflation the way that it is, I think that the Fed has to stay kind of hawkish, or at least they wouldn't be able to, in my opinion, they wouldn't be able to institute the same type of QE as before. So it's just something to keep in mind. There's obviously good points to both sides. I'm here to just give you the information and sort of my take. But my take is sort of, I could go either way. So you do what you want with this information. I just think it's important to bring up. So let's get into a little bit of technical analysis. The S&P 500 is, oh man, it's way up. It's rallying, it's surging. It went through this level, it went through the moving average. I mean, it's heading towards this resistance of 41.75. And it could get there before we see any type of selling pressure. Obviously it filled these two down gaps. It doesn't look good short term, because even in the bull market we saw from COVID, when it was this far above the moving average, it came down. That's when we saw corrections during the bull market. So I don't think it can stay this high above the moving average for this long. Also, if you look down here at the RSI is at 66, which is it's in overbought territory, getting close to extremely overbought for the short term. So that's just something to keep in mind. Obviously, over the long term, stocks go up, but yeah, with this environment we're in, I just don't really see the medium term bull case here yet. So that's just also something to keep in mind. Obviously, the short term trend is bullish, but how long can it stay like that, especially with it rallying this hard? So I want to take a look at Apple, because this is one we've been taking a look at on the show. And it's really the best indicator for where the market is headed, because it's the biggest stock in the NASDAQ for tech stocks, and the biggest in the S&P overall. So it shot through this trend line that we had drawn on it. It shot through its moving average, and it found some selling pressure in this zone like we said it would, but it went through that even. So Apple is looking extremely strong, especially after their earnings. And you know what? A company like this can really hold the whole market up. That's why historically we've kind of seen tech stocks bottom before the rest of the market. So like, say this was the bottom for tech stocks, the rest of the market can go lower than where the rest of the market was when Apple was here. But even if Apple starts to sell off a lot, it might not go back through this 129 level. Now, obviously, it still could go through that 129 level, but I'm just saying, what if it doesn't? What if it sells off and comes all the way back down here? And then that's where we see it rise, and that's where we see the rest of the market rise. If Apple falls this hard again, you could see the S&P 500 go below its previous lows, but you could see the NASDAQ not. So yeah, that's just, I bring that up because usually the NASDAQ bottoms before the rest of the market. Obviously, we could not even be at that point yet, but we could. So I'm not trying to confuse anyone, just I'm giving you both sides because I think that makes you better informed. So next stop for Apple, honestly, I haven't even looked at the next stop upwards yet. Let's take a look together. Let's take a look. Let's find a zone that we think Apple could reasonably come to. So I think this level right here would be one to look at. You see there's a lot of buying and selling pressure off this level, even if we extend it farther this way. So this could be a level where Apple could hit next. Obviously, it gapped up really hard, so we could see something. We would see selling pressure around this level, buying pressure around this level in the short term, and these are the zones that I would take a look at on Apple. Honestly, I'm going to take this trend line off our chart because we're going to need to find a different trend, and let's find one to the bull side. So from right here, I mean, this is a really steep trend, but it was really steep to the downside as well. So let's put this on our chart, and we'll take a look at it next week. So this is what I'm looking at on Apple for the time being. I like to just pull this up because this is our biggest kind of indicator of where the stock market is looking at. And you know what? This company and a handful of companies could keep the market from falling 50%. So just keep that in the back of your mind as well. And last but not least, let's talk about Bitcoin. Obviously, no, let's pull out the weekly. I like the weekly better on Bitcoin because it never stops trading. So you get a little bit better, in my opinion, get better indicators than on the daily. But okay, so first of all, as always with Bitcoin, if you hold Bitcoin, if you like Bitcoin, that's awesome. I love Bitcoin too. I'm not hugely bullish on a lot of other cryptocurrencies, but I am on Bitcoin. It just has a different case than all the other cryptos. We've been in this bear trend for a while now, but we kind of broke out of this range, kind of moving back towards this trend line that we've had on it for a while now, since November of 2021. Bitcoin has been moving with the NASDAQ recently. Why do I bring that up? Because it's been rallying with the NASDAQ. So if you see a heavy fall in the NASDAQ, you could see Bitcoin fall. I would expect it to get down to this 22,000. I honestly wouldn't expect this to hold that much. I'd expect it to go kind of back to the 20,000 if we see some huge selling in the NASDAQ and Bitcoin continues to follow. And then we take a look at that together on the daily dose. And I would break that down for you then as well. But right now, I'm still optimistic on the 28,000. If not the 28,000, then I expect it to hit this trend line. Obviously, there'd be a lot of selling pressure if it hits either of those levels. The longer it takes for Bitcoin to continue moving up, the less optimistic I am about the 28,000 and more optimistic about it hitting just the trend line, which could be anywhere from 24,000 to 28,000, depending on how fast it moves. But we'd also take a look at that on the channel too, on the show. So the trend is your friend. On Bitcoin, the trend is still bearish until we really see it break out of this. Yeah, I'm still short-term bearish on Bitcoin. But if you take a look at the extreme moves on Bitcoin and how long it stays over and under this moving average, it stays over and under longer than stocks. You know how in the beginning of the show I was talking about how the pendulum for stocks usually swings one way or the other? Well, since Bitcoin isn't regulated the same as and able to be controlled the same as stocks, you see that more drastically in Bitcoin. And if we look at the last bull market, it stayed above this moving average from April, well, let's call this the beginning of May of 2020, until January of 2022. So that's what? That's like, that's 20 months. And it's been below now since January of 2022 till now. So that's only 8 months. So we could not see an extreme rise in Bitcoin for quite some time. I mean, obviously that definitely could change, but you can't get overly optimistic just because the price is like so low below the average or so low from the high. Crypto has different bear markets than the stock market, and they have different bull markets than the stock market. Typically, they're both more extreme than stocks. So if we do see that capitulation that we were talking about at the beginning of the show in stocks, you could also see that correlate to Bitcoin. A lot of people have been calling for the 12,000. I've seen even 7,000 on Bitcoin. I've heard calls as low of $600 to $100 on Ethereum, which would be kind of extreme, but I'm just bringing that up to say the pendulum swings so much harder in crypto. So you see more panic, more despair, but also from an optimistic glass half full case, you have immense opportunity. If you have conviction in a Bitcoin or an Ethereum and you see it fall that drastically, yeah, it's scary, but like, oh my gosh, what an opportunity. I mean, what an opportunity to get in at those prices. So as a long-term investor, I wouldn't be so upset if I saw Bitcoin below 10,000. I wouldn't be so upset if I saw Ethereum below 1,000 again. I would be excited because I'm an investor in those coins. To be completely transparent, I am an investor in Bitcoin, I am an investor in Ethereum, and I do not invest in any other cryptocurrencies. I try to bring an unbiased opinion to the show, and I hope that translates. But yeah, I say that to say that if we do see that type of despair and you have conviction, obviously do your research, but don't panic. Use that as an opportunity to gain wealth. That's a huge opportunity. So I'm going to wrap it right here. Again, a lot of information in this episode. Definitely rewatch it if you feel like you need a second watch through. If you're watching on YouTube, be sure to support us on the podcast. There's a link on the channel. And if you're on Spotify, be sure to find us on YouTube. And I just want to say for the podcast, I've been kind of just like keeping track of the listeners because I'm in the early stages of this show, of this channel. And I saw that I had listeners from Denmark and France and England. So I thought that was pretty cool because I'm in the United States. The rest of my listeners are in the United States. I don't have that many listeners yet, but yeah, that's cool. If you're listening from those countries, thank you. Honestly, it does mean a lot to me that you're listening. It means a lot to me that anybody listens and watches the show. I try to provide the best information I can. I'm growing and learning, and I hope that translates to the type of content that I can put out in the future. But I do hope you're enjoying the show so far. If you have any feedback, don't hesitate to send an email. I do believe that should be attached to both the podcast and the YouTube channel, the Financial Wrap at gmail.com. And so feel free to reach out with suggestions, comments, whatever you think. I would love to hear from these early listeners of the show. That would be really, really valuable for me. And honestly, it would just be encouraging as well. So yeah, thank you for watching. Thank you for listening. And make sure to stay tuned this week. I hope everyone has a great week and invest safe.